What's up, everybody? Welcome to the first official DeFi Learning to DeFi series with the Katana team. I'm here joined with Will and Matthew. I'm going to go ahead and let you guys introduce yourself. Will, go ahead and take it off.
For sure. What's up, everyone? So I lead the engineering team over at Katana, and yeah, all things related to engineering. Prior to that, I led the DevOps and platform team over at Polygon, and that was just a long string of startups for me. Started in crypto back in 2017, both from an investment perspective and just trying to figure out what blockchains were, how to build them, and then how do we turn that into a product or a company that actually does something that someone in the world cares about.
Cool. Nice to meet you guys. Will's great, by the way. I guess I started investing a little bit in crypto in 2018, but been working in crypto for the past 5 years. Started off at Libra, working on trying to get Facebook stablecoin and blockchain up and running, but obviously the US government had other things to say about that. Been in DeFi exclusively the past 3 years. Joined Polygon about a year ago to work on Katana. I think a lot of discourse has been like, why do we need new chains? But when I actually heard about what they were working on inside of Polygon, I agreed with a lot of things that I thought that kind of the industry was kind of crying out for as well. And then, yeah, leading a lot of the business stuff, institutional liquidity, protocols, all this other kind of things too. So excited to get into it.
And I am Billy Jitsu in the streets and the Twitters, your favorite DeFi DevRel on here. So yeah, DeFi for me, I've been in the game since 2017 during the Christmas rush. I thought it was a genius. So I was like, hell yeah, I'm going to retire. Let's close all these stocks out. And then I survived 2018. But it wasn't until 2020, 2021 when DeFi summer came into play and Ethereum was so expensive for me. And I missed the Binance chain, and I started learning how to borrow, lend on Aave with the Polygon incentives. And like, I was like, whoa, this is crazy, right? Like we talk about a lot of different things. Like you have all these big name brands like Kiyosaki, you know, the rich dad, poor dad, like get passive income, do this. I was like, well, I got to buy a house. I got to drop like 500K to like earn passive income. And then in comes crypto with DeFi, and you have DEXes, you have borrow lending, you have perps, you have all these different ideas, PTYT, like yield tokenization, where you could start earning yield with $100, right? And just learn the flow of like how this entire thing works, right? Like it's open to everybody. And that's kind of what the beauty of DeFi is. And that's why I really like it so much. It's kind of why I joined the Katana team, right? Like I like DeFi. I loved how everything happens in the space, how much innovation was happening. And then when I learned about what Katana was doing, I was like, this is cool. This is something different. We're giving something a little bit more unique for the DeFi users. So I'm in, and hence I'm here. But the thing is, a lot of people don't understand DeFi. It's kind of scary. A lot of people don't understand TradFi to begin with. And DeFi taught me a lot about TradFi. And when I started, I messed up a lot. There was a lot of terms I didn't understand, and permanent loss, like what is liquidation, like what does all that mean? And so it's very scary for anybody that just kind of like messing around with crypto, that just buys and sells on exchanges or used to buy NFTs or wants to just deposit in a vault. You don't know what risks you have. You don't know what's going on. So you kind of just blindly click and hope for the best. And so this series is the series that I designed that I wish I had when I started, that would kind of tell me like the real talk. Like I see videos and content about DeFi that have all the nice stuff. Hey, earn 1,000 APY over here, earn, 500 over here. And like everything's great and dandy. And then when you go do it, the rates drop and then you end up with less money than when you started. So in a sense, before we even get started, I want to kind of like just lead it over to Matthew of like why Katana was even built to begin with. Like what is the whole point in the sea of layer twos?
Cool. Yeah, I can go back pretty far, but I think I'll stick to about like a year ago, probably a little bit before us three, I think, got here. But Polygon had this thesis that general purpose blockchains and general purpose block space will cease to be as important. And if you don't build a chain that's purpose built for a vertical, I'll build one that's better than you. And so with that, I think it's become clear and clear to the market that Polygon has only been focused on payments over the past like 8 or 10 months. At the same time, Polygon was not competitive in DeFi. And so it kind of needed to restart after kind of betting a lot of the things on the enterprise thesis in 2022, which kind of culminated in FTX. So that's like a lot of the ideas with Katana. You can't do that retroactively for a chain that's already been live. So there's different concepts around vault bridge, around opinionation, around kind of king making some of these protocols and assets that it's really, really tough to do if you're not doing that from day one. You can introduce new risk to users that are already there, and without being super clear and knowing people don't necessarily actively manage and read different governance forums, it's just really impossible to do it without a new chain. So that's part of it. And with that, you kind of need a new token, and that's kind of we look to GSR and have other partners around that too. But in terms of conceptually, Katana was basically started after realizing there's just a ton of fragmentation, both across different chains, across protocols that do the exact same thing, and across assets that serve a lot of the same purpose. And so Katana was primarily built to kind of solve for this and be this liquidity hub that basically imports liquidity and exports yield to all these other chains in a very cross-chain, like interoperable vision that over time will look very seamless in terms of cross-chain interactions and vaults that kind of can go across it. So again, I can kind of get into anything more, but I'll kind of pause there.
For sure. I think like when I talk about Katana in general, a lot of people don't understand the value prop of it because they don't understand DeFi just yet, right? And so if you start learning about DEXes, you start learning about borrow lending dApps, and you start learning about all the different tools that are out there, and then you realize what will be set in Katana and how we built it all together as like a unique ecosystem with a chain that is kind of evolution about it versus individual dApps, I think you'll get it. Hopefully you'll get it, right? And so we're going to go ahead and start off, enough chatter. Let me go ahead and just add the stage of like what we're actually talking about here. And then Will and Matthew are here to keep me from being boring. If anything's boring, just say, shut up, Billy. Let's talk about more stuff. But let's get into it. And I see the comments on there. Yes, go for it.
I was just going to say, I think to keep it engaging and make sure people will continue to ask questions, probably should answer those questions kind of as they come in.
Yep, as they come in. So yeah, I have like gecko eyes because I got one screen on this way, one screen here, and I got you guys are my eyes and ears on there. But yes, and I actually can't chat because I don't have access to the Katana Twitter directly, so I can't respond to it. But we'll just talk and we'll bring it up on there. But welcome everybody. Thank you guys for joining. But here's the quick introduction of like what we're trying to do here. So welcome to Katana. Here is our cat. Understanding DeFi 101. I feel like these are the foundational things of DeFi that you should understand as a DeFi user. Whether it's a DEX or borrow lending, these are the things that I felt like when I was starting out that were very confusing to me. So this is what's going to be covered in a series of certain things. Today, we are just doing DEXes today. It's a lot of content. We're going to think maybe like an hour roughly to get through this. I don't want to bore you guys to death, but like really things that kind of scare people, like impermanent loss. Like, what does that really mean? In debt, we hear it, we're like, loss, that's scary to me. I want to do that. How do people actually make money, and how do people lose money in the space, right? When I deposit $100 into an LP position and I pull it out and I get 99, what happened, right? Rebalancing, like as I create my own strategy, like how do I rebalance? What does that even mean? And what are the risks I take when I put my money into this? Besides smart contract risk, what else is there, right? And that's something a lot of people don't get into in detail. And then in the next session that we'll have, we're going to be covering borrow lending and then PTYT tokens. I feel like PTYT tokens are something that really scare a lot of people because they don't understand it, like yield tokenization. Like, how does that work? And how does that like work into everything? So people don't take advantage of the crazy rates that you can get with PTYT tokens on there. And then perps, a lot of people, mess with perps like 2025 towards the end. People were just like 50 times leveraging or 100 times leveraging, and people were like getting excited because the market was great, and all of a sudden 10 came along and then blew everybody away, and they're like, I'm never touching perps again, right? Well, I'm showing you guys how to like maybe properly use it, or maybe the best way that I do it as a strategy. And then ultimately the final one will be like cat tokenomics. Why do we have another token? Is it just another network token? No, it's actually designed to like put all these things together in a single ecosystem to support it like never before. And the reason Cat's born to me is like, has there been a design to like have a whole system in place of ecosystems where it's not individual dApps working individually? Like if you just deploy a dApp on Ethereum, you're kind of on your own in a sense. And so it's up to you to, do whatever you need to do, up to you to marketing. Here, it's all about an ecosystem of how everything revolves around cat on there. So that's it for PowerPoints. Let's get right into the actual thing here. I'm using Excalibur, so I don't see that on here. So let me remove that and reload my screen here. I'm going to stop screen sharing, and that should have just done a whole window instead of a thing, but let me do the entire screen, and that should be better. There we go. So going a little historically, and it's going to be a little bit slower. I'm using Excalidraw because if you guys have any questions or anything, I can draw that on the fly and kind of just draw it with you. But hopefully that is nice and clear. But we're going back into buyers and sellers, right? When you started in crypto, your first interaction is probably through an exchange, Coinbase, Binance, or whatever obscure exchange you had. And ultimately, you were a buyer of, let's say, ETH, right? So let's say I wanted to buy 1 ETH for 3K or whatever the rate is right now. Will wants to sell, 1 ETH for 3K. We have a perfect match, right? We're like Facebook marketplaces. Hey, you don't want to sell yours? I want to buy it right for this price. Perfect. We've created a nice little market on there. But that's not the reality, right? Most of the time, we'll have a buyer that wants to buy ETH at like 3K because that's what the market is. And then I have a seller that wants to buy one at 3.1K, right? It's like, I want to sell at 3.1K. Well, now we don't have a market, right? Because I don't want to pay more for it, and this person doesn't want to accept anything less. So what exchanges usually do is they have some kind of market maker that will buy some for a little bit less and then charge an extra fee and then sell more for a little bit of fees back and forth. So they keep the market moving back and forth in a sense. So without a market maker, you really don't have a good economics because you don't have enough buyers and sellers that balance each other. So you kind of need like somebody in between to keep these markets moving. So in a sense, all we're doing is kind of creating like a pool of mixed funds here that I want to buy 1 ETH for 3K. I want to sell for 1K. And like we have all these mixed funds of like ETH and USD or USDC to kind of keep the markets moving, right? So in the early stages of Uniswap, it was very, very innovative. You've all probably done something where you just swap one token for another. Well, we've decentralized that exchange, right? We've done an automated market maker. Instead of having somebody do the market making itself, it's automated. So like it's one of the most revolutionary things that's ever happened in the crypto market that got me super excited of like, hey, I'm sitting on like one token. I want to swap it for another. I don't have to send it to an exchange or bring it back. And then I can just do it right here and then continue on my day and invest on any new token that I want. And so that was like one of the things that kind of like blew my mind. It sounds stupid now in 2026, but like when it first started, I'm like, whoa, this is crazy, right? So how does it
real
work?
quick.
Yeah.
So like one of the things that helped me getting into this was like understanding the difference between a centralized exchange and a decentralized exchange. And the way that I ultimately broke it down in my mind, and this by far is not a perfect analogy, but it was good enough to get me understanding where I was at, is thinking about a centralized exchange is sort of equivalent to like your Walmart or your Home Depot, where it's a company, you go in and what's on the shelf is there and that's the price for it. But when you get to a decentralized exchange, it operates more closely to like a flea market or a swap meet where anyone can choose to be a vendor, and that's your LPs who are supplying and they're setting their price range. And then when you go to the decentralized exchange or the flea market, then what may be there on Tuesday may not be there on Thursday, and the prices may be different. But that's sort of the environment of the DEX, is it's much more swap meet or flea market oriented, whereas on a centralized exchange, it's a very traditional retail type experience.
I like that analogy. That's pretty good. Yeah. I've never thought of it that way, but yeah, like the flea market of crypto tokens.
Right?
Yeah. Awesome. So automated market, like what powers this DEX, right? In a sense, and that's basically market making pools, right? Liquidity pools. You'll probably see this all the time. I'm going to bring this over from like Sushi Swap right here. This is most likely what you see on a DEX, whether you're using Uniswap or any other kind of swap exchanges, you'll see this. And then when you're exploring, you're going to see like a whole bunch of like random assets back and forth. These are liquidity pools, right? Basically, has two tokens, right? It'll have one token with this case ETH and this other token USDC, and they are basically a mixture of both tokens where you can basically use your market making, right? So it would require a lot of different pools in order to have a different amount of markets, right? Like you're basically swap meet or flea market kind of things. Like this person's bringing in this token, this group is bringing in this token and this stuff. The beauty of that is with it, you can actually hop between certain things. If you've ever gone to a centralized exchange, let's say I had some ETH and I wanted some Lombard BCT, right? I want some LBTC. I'd have to sell the ETH first into USD. And then with that USD, pay a fee. And then with that USD, then buy the LBBTC. right? And so I have to do a two-step process in order to do that. With DEXes, they allow us to actually hop in between on here. So if I wanted to swap directly from LBTC to ETH, I can do it via a routing schedule. And I'm not going to get too much detail because that's more for the coders on there. I'm keeping it kind of general user, but kind of hinting at what you could do as coding, or a liquidator or an arbitrager is your routing. But as I throw in my LBTC into the DEX, so if I wanted to swap it and trade it, right here as my DEX, I would pop in my LBTC. The LBTC will go into the LBTC USD pool. Internally, I'll get this USDC. I'm going to hop over to the next liquidity pool into the ETH USDC because I have USDC here and I can trade that pool, and then ultimately end up with my ETH. So it's a very simple flow of like how I can swap one asset to another, right? And then there's a small minimal fee in order to do that swap. So who actually provides these pools, right? And like, where is my screen? There we go. Oh, sorry. Price slippage.
The beauty of the live stream.
Yeah, there we go. So I kept it far enough so like a lot of the animations don't overlap with each other with Zoom. So I'm keeping it in there. So what decides your price impact, right? And I like to use my apple and oranges example a lot. Let's say, supply and demand, right? Like people hear like, oh, you got slippage on this, and people don't understand the concept of how much liquidity you have in a pool. It really affects what you get when you swap out, right? So let's say I have a liquidity pool with, apples and oranges here, and I have an orange right here, and I'm sitting here with it, and I want one of these apples, right? What really happens in that DEX swap is I pop in that orange right here, and I say, here, you take this orange, and at the end, I get this apple, which is great. They were 1 for 1, and I swapped in my orange, and I got exactly 1 apple, right? But what happens if I have another orange, and I want to swap again? Well, now the rate has changed, right? Because now it wasn't 50-50 before. Now there's way fewer apples than there are oranges. So now that rate has changed, right? So if I were to swap it again, I would not necessarily get 1 apple 1 for 1. I would get like a piece of the apple. So I'm like, what happens? That's where I might have slippage, right? Where I don't have enough liquidity. So if I keep adding more in and it's unbalanced, when I swap it out, it's just not going to give me the same amount that I would expect when I come out. So that's the difference of having a low liquidity and like having enough deep liquidity, right? So what if these were stable coins, right? What if this was 1 USDC and USDT? There is no way that I would pay $1.50 for 1 USDT when I have USDC, right? And that was why Curve was born, because of like certain slippages and certain things. So they had more like 1-to-1s, right? So that was a big problem that we had in V2. So when we talk about deep liquidity and when we talk about Katana, that kind of focus is like we only have certain pools that have deep liquidity. So when we're talking about that, let's say these were 1 million oranges, right? And I had 1 orange. If I popped in 1 more orange and I took out an apple, it really doesn't make a lot of slippage, right? Because we have enough liquidity to take that cost. Whatever the rate is, it's not going to affect the pool in general. I've seen so many times people DM me, hey, I swapped this token for this, and I only got like half the value. And then I look at the pool, and it's like, oh, yeah, there's not enough liquidity in there. So you just got a lot of slippage and you got wrecked, right? So these are the things to look out for when you're swapping and you're getting quotes. You want to make sure that your pool has enough liquidity on there in order to do that, right? So going back to that original question of like who handles this, how does this all work, is like when we had this problem with slippage, we had something called V3 ranges, right? Uniswap came up with this new thing with V3. I think it was around 2021. That kind of like just crazy math of stuff of like the concept of concentrated liquidity, right? So bringing back like that ETH USDC kind of pool. And if I lose you guys, feel free to comment on there. Or we're like, the whole point of the live stream is so you guys can comment or have any questions or anything. So feel free to stop in and guys chime in if anything. But with ranges, right, concentrated liquidity, you hear that a lot. In the V2 days or the early days of swaps, we used to have like a full range, right? It would go, if I put in an ETH USDC pool, it would go from 0 to infinity. So if ETH became 10,000, like we were all expecting in 2024, 2025, you would still have liquidity. But it was a waste of liquidity, right? Because the current price that we were dealing with was in this range. Like right now it'd be 3,000. So if we did a V2, we'd have all this liquidity available, all the different price ranges, but we're only trading here. So we're really only trading these 4 pieces, these 4 apples and 4 oranges. So having all this availability was just a waste. So that's why we'd have a little bit more slippage. And so like when you would swap, you'd have to mess with your slippage settings and you're like, oh man, I'm not getting what I need. And so I would just stop that swap. So with concentrated liquidity, they're like, hey, why are we going to waste all this space? Let's all put it all within a certain range, right? So then we have this concentrated liquidity. Let's say ETH was 3,000. I don't know what the price was going to be today. So I'm just saying, let's concentrate it between $2,000 and $3,000. So now instead of having this full range, all our liquidity is concentrated in that range of $2,000 to $3,000. So now within that price range, all the swaps are way more efficient. And that way, like all my money gets used within that price range in that spoke. So that's what we mean about concentrated liquidity, is like when you're looking at stuff and you want to create an LP position and they start asking you, do you want to do full range? Do you want to do a certain percentage? You know, this is exactly what it means. It's like we're choosing ranges that our money is going to be sitting on, so it can be the most efficiently used and lower the slippage as much as possible.
Yeah, I think another way to look at it is if you're supplying to the ETH USDC pool, the question you're really being asked is what, how much USDC are you really willing to accept for your ETH?
Mm-hmm.
And if I'm selling my ETH, I'm not really willing to accept $1 for it. I'm sure there would be plenty of people who would buy it for $1, but I'm not willing to accept that. And so that's where I set my range on there, is like, okay, I'll take anywhere from 2,900 to 3,100 for ETH, and that's it.
Yep.
And that way, if somebody comes through with an offer for $5, like it's just not even going to get considered.
Yeah, it really depends on the way you look at it. I'll kind of cover it a little bit as you get like impermanent loss of, like, some people like to dollar cost average, and I'm not. I think of it that way, of a DCA out. So like, where do the pools get money from, right? Like, who provides this liquidity? It's you guys. It's you guys, investors, market makers, liquidity providers. That is the beauty of crypto in a sense. Like, anybody can participate to do this, right? You know, by providing money, your money or liquidity to this pools. Like, when you provide money, that's what we call like providing liquidity. You earn the trading fees from the volume of the pool, right? So if something's hot, if there's a token that's hot and you are providing liquidity, you are earning a piece of those fees every time somebody swaps, right? So whether it's a Link token or ETH token or whatever hot token that is, you are earning fees on that for your position, right? And whether it's relative to your position. So adding your money to earn fees, providing liquidity, as we'll call it, just to make sure that you have to understand, is there's a lot of things to consider, right? Swap fee rates, right? So there's different free rates. So if we look at this sushi right here and we go to explore, you're going to look at the different rates that they have. Let's see here. If I have right here, I'm going to try to zoom this in. You'll see underneath the WETH and ETH, you'll see this 0.05. Over here, USDC, USDT, you'll see 0.01. That can be confusing for a lot of people, but it's the smaller the swap fee, the less you earn. So why is that the case, right? When you have like a low fee, like 0.05, those are for stable assets like stable coins, or like assets like ETH to wrapped ETH, or, you know, ST ETH. Why would I ever pay more for another stable if I have $1, right? So like if I have 1 USDC, I'm expecting to get 1 USDT or 1 AUSDT, right? Like those are things that I would expect that would have almost a 1-to-1 ratio. So if I have a huge fee, that's going to make it drop a little bit. So the market has kind of averaged out that it's 0.05 on here as well. Median fee is what we normally look at. Like if you do ETH USDC or wrap Bitcoin USDC or USDT, 0.3 has become like mostly the standard of what you get. And then when you have those high fee, like meme coins or those exotic tokens that are a little bit more high risk on here, you have a high fee of like as high as 1%. Those are for like crazy volatile pairs. Like if you want me to provide liquidity for that, it has to be worth my system right here. So when you create a position, you create an NFT. Back in the day in V2, you used to get an LP token. Now you get an NFT. So why do you get NFTs instead of an actual token? We have the same LP, but we different ranges. So like if I pop in $1,000 of ETH USDC, and then Will and Matthew also do another ETH USDC, but my range is 2,500 to 3,500, and Will's range is from 3,000 to 2,000, and then Matt's range is like 2,000 to 4,000. We put the same amount of money, but we have different ranges. So the NFT is what makes our positions unique, because it's the same dollar value, but our ranges are widely changed, right? So for those developers or those NFT traders that don't understand it, like these are the one unique cases that I thought was really cool for NFTs, of like, you have the same position, but they all make your positions unique because they all have the different ranges. And so NFTs, like when I was trying to build and learn it, I was like, why NFTs? It doesn't make sense to me. Why not LPs? Because I was used to V2. So using that NFT is a tradable asset, and it's much easier to swap or change to another wallet. Instead of breaking away your LP position and moving it together, you could just swap that NFT to another wallet, and then that position carries over. I don't think there was ever a market because the SEC was kind of rough on that, like having it on OpenSea or having a tradable NFT. But there could be a market at some point to make that happen. I don't know the rules. You know, I don't. Your country rules may value on that, but don't take my word for it. So
right, not financial advice.
Yeah, not financial advice. None of this is financial. Yeah. So TVL and volume is the key for this, right? Like the size of your position in the liquidity pool is basically how much money you're going to make, right? So if there's not a lot of volume or there's not a lot of TVL, sometimes you don't get enough of that volume. But sometimes, and I've done the math on this myself, is like sometimes you got a hot chain with a ton of TVL, and then my position, let's say I put $1,000 into it, is so small that my fees are like nothing, because I see the volume and everybody's like on the timeline, oh, this is the spot to put your liquidity. I'm like, great, but like I'm getting nothing out of this because I have such a small position. And then I put myself in another position that doesn't have as much volume or TVL, but because I own more of that position, I get more money, right? So you have to be really wary of that, like what's hot and what's not. Don't follow the trends, follow the math, right? So just to show you a little bit of detail, I found this pool position of the total volume locked, right? That's what TVL means, total volume locked. There's a position of ETH USDC pool. It's 99 million. I happen to be a millionaire and I want to deposit $1 million. I'm just keeping the math simple right here. So then when I deposit when I deposit my $1 million, the total TVL of that pool is $100 million. In fact, I own 1% of that liquidity, right? 1% of that whole position is mine, meaning I'm going to receive 1% of all the trading fees for that pool. So the amount of volume matters because that's what people are swapping fees, right? So if you have a lot of trading volume, that means people are going back and forth, trading between that token, or the prices dropped or the price is pumping. Lots of things are happening on here. So I'm going to do a little bit of math for you, and this is good math for you to understand. But you can always ask Cloud Code or Chat GPT or any of these AI units, because it's like now it knows what it is. But the money that you make is relative to your liquidity over the total pool liquidity times the trading volume, is like how much volume was traded versus the fee tier, right? So putting those numbers in, I had $1 million of liquidity, right? Over 100 million total value locked, times, let's say there was $10 million of trading volume, whether that was an hour, a week, or a month, whatever that was, or 20 seconds. And then the fee rate of that trading pool was 0.3%. I will have made $300 USD value. Whether that's in USDC or USDT or ETH, whatever that pool was, I will earn $300 whenever that $10 million of trading volume happened, assuming that didn't change. Some people pull liquidity, some people pull in. So you can calculate, all right, if I put this much in and I own that much, how much am I going to make? So even if you see the hottest pools, or even if you see the hottest things that are like crazy volume, if your position is way smaller and they make your liquidity position like micro, look at how much you're going to earn. You're like, okay, that's not a good spot for me. Let me find another alpha spot that I can put in some money on here.
So where would someone go to see what the pool size that they're considering is?
That's perfect. A good segue into the pool. So like you're going to check a lot of different DEXes right here. And so in the sushi, I'm going to go right back into the trade again. I'm going to explore. And then when I'm exploring, and I'll explain this all in a little bit, but you're going to go right down to the pools directly and you can look at it. So if I was looking at USDC ETH, I can see that the total TVL here is $6.52 million. And the volume that happened in the last 24 hours is $6 million. And the volume for the past week has been $34 million. So based on that information alone, and the fee tier right here is 0.05. So I can do my calculations of how much I would earn on there. Now, that's not the whole story because there's also incentives, but I'm going to come back to that in a little bit. I don't want to overwhelm you guys in just a bit, but that's the basic logic behind that. So coming into certain things, the tighter the range, the sweeter the APY, and that means annual percentage yield. You'll probably see that interchangeably a lot, APY, APR. So APR is like your annual percentage rate. You'll see that mostly on borrowing on certain things. Like if I'm borrowing some USDC, it's oh, your APR is 5%. APY just means that you're compounding. So let's say I put $100 in at 10%. At the end of the year, I'll have $110, right? But if I compound it, let's say at, just for simplicity, at end of 1 month, I'll have $1 earned. Well, then I want to compound. I want to put that back in. So I want $101 earning interest versus $100. And then on month 2, from $101, I have $102. So I want to concentrate yield on that. So it'll keep adding yield as I'm adding more of that value versus separating the $100 and just earning the $10 at the end of the year. So hopefully that makes a little bit of sense on there. But when you look at APY, that just means they're auto compounding the value for you on there. And APR means they are not. It's keeping it separate. So you'd have to manually do it if you wanted to, right? So concentration, right? We were talking about certain range. When we talk about concentrated liquidity, we want to talk about certain range. Do I want to be between 2,500 to 3,500? Do I want to be from 2,000 to 4,000? Why wouldn't I want to be like super open so I capture all the fees, right? Like I want to be from zero to 100% of whatever it could be. Well, because the tighter you keep it, the more efficient you get, the more percentage concentration yield that you will get. So just a little bit of math, and you don't really have to know too much about this. Is like how much concentration you have is the current price. So let's say the current price right now is $3,000 ETH. I haven't checked CoinGecko or anything. And then my range is going to be how far do I want to go up. So for our case, keeping it simple, I'll go as high as 4,000, and then the lowest price I want to go for ETH is 2,000. So my current concentration range would be 1.5. So here's a quick little table on here of like the range width. If I want to go 50% higher or 50% lower, I would have a 2% range or 2 times concentration. And if I keep it super tight with just a 1% range, I'd have 100x concentration, like super tight. We're talking like $10 or anything like that. Just like crazy range where you crazy fees. So the new math would then be your position value times your concentration with the other formula, right? The total pool liquidity, the trading volumes, and fee tier. So the tighter you have it, the more efficient your dollar is being used in that range, and the more fees you will earn on here. But, so the question would be, why not just concentrate as much as possible? I want those advertised rates that I see in a lot of DEXes. I want that 400 APY on that ETH USD pool, and I want it forever, right? I want to make my money back in 3 months and then double my money. Well, it doesn't work like that, ideally. And this is how people really get wrecked. And this is like we're getting into the juicy stuff of like how DEXes work. The concept of out of range, right? So let's say I did do that crazy concentration, right? And I did an ETH USD pool of $29.90 to 3,000, right? $10 range of like, I would say, was that 1% change on there. So what happens with ETH, right? When I'm talking right now, ETH could be 3,000. By the time we're done with this presentation, the ETH could be 3,150, or it could be like 2080. Like we don't know. It like if you look at the chart, it just goes up and down all day long, right? So I have my concentrated position between 29.90 and 3,000, and as I'm talking, ETH just turned into 3,001, right? 3,001, 3,005 seems to be the range they're trading for. When ETH is 29.90 to 3,000, I'm taking the fees, right? But when it's 3,001, all the trading's happening here. I'm making $0, right? So all that time that ETH is in this price range and everybody's trading here, all my money is just sitting there doing absolutely nothing. So it becomes the game of like, okay, where can I find that range? Where is the market going? Where do I feel like that the market is playing, in a sense of like, what ranges do I have? For me personally, I like doing with $1,000 low, $1,000 high, depending on where the market is. I figure if it stays in that range, I'm in a pretty good spot. Some people don't like that APY. Some people like to do something called rebalance daily. So they want that tighter range. It really depends on how much it's worth to you to sit in front of your machine and play that game, right? I like to set and forget for a little bit. Some people like to sit and be locked in for quite a bit. So really defending that range. But you have to understand that if you have a certain concentration level that has a great APY, that's great for you as long as you stay in the range. But if you don't, you're basically earning nothing in a sense. So that's why we don't max concentrate to get the max fees. So those advertised rates that you see that you get, you got to do the math to see if you're actually getting it, because that's assuming you have a super, super tight range. And then you're like, oh, I didn't, and I got out of range, and then you get wrecked on here.
Yeah, for sure. There's a direct relationship between how tight your range is and how much work you have to do on a daily basis to keep to keep earning that APY.
Yeah.
So it's not free money. You're working for it.
Yeah. I've done it a lot. Like I've done like, oh, I'm going to update every day, every 24 hours, I'm going to rebalance and do that. And at the end of the day, I'm like, I'm doing all this work. And if I just left it alone with a lot wider range, I would have made the same amount of money. But I think you have to go through it a little bit to realize, you know what? If I just put it between this range, I would have made $100 instead of like working 2 hours every day and then walking away with $100. So it's kind of like this back and forth I'm here. But the scary word that scares everybody from doing LP positions or even like popping in or zapping in, impermanent loss. What does that mean? Like, what is that? Like loss? I don't like that word loss. Nobody hates it in crypto here. But as you get closer to your range positions, what happens to your LP position? And this is what a lot of people don't understand. And if you do understand, I feel like that could be a good strategy for you, right? So let's go back into that ETH USDC example. 2,800 to 3,000 is my range. The price is 2,900 right now for ETH USDC, right? And so coming back to these apple and oranges, I'm going to say my oranges are ETH and my apples are USDC, right? So I did a 50-50 LP position, ETH $2,900, right? So I have just, 3 oranges of ETH and 3 apples of USDC. Now the market is shifting, right? As soon as I popped it in, ETH went to 2,950. What happened? Well, now ETH is on a way up, right? So it's going up. So I am going to be selling some of my ETH as it gets traded in. I'm getting a lot more USDC in my LP position, right? I am dollar cost averaging out of ETH in a sense. So the ETH went to 2,950. I sold a little bit of ETH for that for more USDC. Let's say it's on a run. It goes to 2,975. Guess what? I have even more USDC in my pool and I have a lot less ETH, right? So as I'm getting closer and closer to my range, I am ending up with the lower value asset on here. So I have more USDC and I have a lot less ETH on here. And then once we get to my final part of the range, I am fully in USDC. There is no ETH in that liquidity pool. I have basically dollar cost average out. I end up with a little bit more USDC than I would to begin with, but I'm all in USDC. I'm set with that asset until, until it comes back down. So if ETH comes back to 2,975, guess what? I am dollar cost averaging back into ETH at 2,975. So it's coming back down. I'm getting more ETH in my pool. Same thing for 2,950. Again, I'm getting a little bit more ETH. And then on 2,900, I'm back to being even again. And then if the market starts dropping 2,875, guess what? I'm getting rid of some of my USDC and I'm buying more ETH. I'm buying ETH at discount, 2,875. And then I'm getting 2,850 as it goes down. And then once it gets to 2,800, I'm all in ETH, right? Everything is out because I hit the bottom part of my range. So, and the concept is your position holds the lower value asset in whatever direction the market moves. And that kind of sucks, right? But that's why they say, oh, LP providers are just liquidity providers for arbitragers, right? Because the moment I put in some ETH and I put in some USDC, whatever the lower value is, I'm going to end up with more of that the moment I do that. And so like I'm at a loss in the beginning. And that's the reality of it. And that's what a lot of people don't tell you is when you create the first LP position within that first 2 minutes, you're already at a loss because arbitragers will come in and they rebalance it, right? In order for these things to stay in market, like ETH doesn't know what the price is in USD terms. It does not, but arbitragers too. So like if you create LPE, they're going to swap, like, hey, ETH is at a discount on the sushi range. Let me swap out and sell it on an exchange or sell it on another DEX, right? So they will balance out the LP position to make sure that it's at market value. And therefore, by you providing liquidity, you're going to end up all, with the lower value asset. And yeah, I see the comment. Yeah, you do collect all the fees, but how long does it take for you to collect all those fees, right? So let's do this impermanent loss calculator in a sense of like what we also call divergent loss. Was it better just to hold, right? Like I do all this work, and sometimes you do like a lot of traders trade all day. And they're like swing traders and trading all day. And at the end of the day, it was just easier to hold ETH, right? Like I would outperform the entire market if I just did this. If I bought some gold,
and I still have less money.
Yeah. If I bought gold at the beginning of like 2025, I would have outperformed everything. I was like, okay, cool. Instead of being locked in. So with impermanent loss, like how do people get wrecked, right? Like scenario of hold versus LP, right? We're going to say the current price of ETH is $3,000, right? So my starting position right here in the wallet, I'm holding 0.5 ETH at $3,000 value and $1,500 USDC, right? And I created an LP position within a range of like 22%. I'm just keeping this simple because I use like some offsite calculator to do that. So my concentrated calculation would be, my high range would be 3750 and my low range would be 2400. And so my range width is about 1350 either direction right here, right? So my concentration is a 2.2 concentration. So just to reiterate, my range is 2400 to 3750. My 0.5 ETH and $1,500 USDC is a total value of $3,000 with a concentration of 2.2. So I just did a quick calculation of like what happens in here. So at the $3,000 entry, you'll see that I have half an ETH, the 1,500 USDC, I have no impermanent loss right here. Let's say immediately, as soon as I pop this LP position, within 1 minute, there's an announcement from something and it just ETH takes off. And it goes to 3750 right off the top. You'll see that I have no ETH. I have a little bit more USDC, right? I have a little bit more than $3,000. I have been dollar cost averaging out of ETH. So I have an LP value of 31.77. But if I just held my $1,500 in USDC and my half ETH and I sold it at the top, I would have made 3,375. So I had an impermanent loss of like almost 6%, right? And then the same way goes the other way, right? If ETH drops to 2,400 on my lower range, I end up with more ETH, right? I have no more USDC. My LP value is 2542. And if I just held, the USDC would have been kept me up above. And again, almost down 6% on here. So down 158. So it works both well and positive for you and negative for you, right? If you're a person that kind to like round trips the entire market, sometimes if you're a round tripper, if you're like, oh man, ETH is going to get to 10K and you didn't sell any of it at some point, then I would say do some LP positions and dollar cost average yourself out of the market, right? So like I did that personally for some ETH positions between 3,000 and 4,000. And as it got to 4,000, it ended up being at USDC. So I dollar cost averaged some of those ETH positions out of 4,000. If I didn't, I would have just round tripped it and it would have been back to 3,000 again. It's like, oh man, I should have, woulda, coulda, shoulda sold, right? Or if you want to dollar cost average into an asset, like, hey, I'll dollar cost into ETH. Let me create a position. And if we go sideways, I'm earning fees. If not, I'll end up with more of the whatever asset I want, right? When I LP something, I LP stuff or liquidity position or provide liquidity. I do stuff on tokens that I don't mind holding for a long time. So whether it's kind of like if you see me talking about Billy Coin, don't buy it. Don't LP it. Don't do that. So
Set alpha.
Again, yeah, no, there'll never be a Billy Coin unless it's some kind of meme thing on a testnet. It'll never be on a mainnet on there. So why would anybody do this? I told you all the bad stuff. Oh man, this sucks. I'm losing money. I'm going to get liquidity position. I'm going to lose all this, all this money. Why would I ever do that? Right? Incentives, rewards to offset the loss. Like, okay, this is where it is. You're earning fees. Maybe the fees are not earning enough for you to cover that loss, but there's always going to be incentives on here, right? The longer you're in range and the volume is good, you will earn fees. I love a crab market, like how ETH has been sitting at 3K going up and down. That's my moneymaker, right? Like everybody's waiting. Hey, go up, go down, do something. Like those memes do something. I love staying static because that means I'm earning fees on every swap. Every time it goes up, down, $10, $100, I'm making money, right? But sometimes those fees aren't good. It's going to take too long to matter. Like if I did it just on fees to earn my money back or to buy out my LP position, it's going to take like 3 years in order to do so, right? So like just the swapping fees alone is going to take me a couple of years. Yeah, I am using Windows in 2026. I also have a Mac. So there's incentives to provide liquidity. Every DEX, every opportunity, like even chain levels will give you incentives to actually do that. So if we look here, and I was looking at the ETH USDC one, you'll see that we saw that 100 and something percent, right? So it's like, hey, this is the logic, right? You have fees that are going to get 16% right off the top. And there's also going to be some rewards at 177%. So in total, for providing liquidity at the Sushi swap on Katana, you're going to earn 193.88%. That doesn't stay the same all the time. Fees go up and down, but the rewards are general. And what are the rewards breakdown is that you're actually getting some CAT tokens, which are heavily incentivized. And then you're also getting some Vault Bridge rewards as well. So you're getting pure ETH and pure USDC as well. So those help you offset your losses on there. And so that's kind of like what we see. And so those that have used DEXes on there, you'll notice that those token rewards deal with a ton of sell pressure, right? You see it all the time. Uniswap, Sushi Swap, and any kind of individual dApp, they all have to struggle with actually keeping up with the price, right? Everybody's like, oh, bad tech, price is down, we hate it, right? That's just how it works on there. So I'm going to come at you with a Katana value prop right here, right?
Before you do, I want to jump
Yes.
in and say one of the things you said that really resonated was you LP for tokens that you don't mind holding. I think the same thing is true when you're looking at the rewards. You know, when you look at that APY and you're like, oh, dude, that is nuts. Look and see what the rewards are in and make sure that that also is something that you actually want to hold.
Absolutely. Yeah. And a lot of people have been kind of trained to actually just dump the token, right? Like that's the
Yeah.
kind of problem with like single applications. They really struggle with that, right? But at Katana with cat token specifically, and we won't get too much into the cat token tokenomics. There's a whole workshop into that, but there is a chain-wide effort to keep this value high, right? Like if I deploy Billy Dex on whatever chain, who else is going to support me, right? Like it's my and myself's team in order to keep this value prop up, right? And the most people that run strategies are immediately going to sell. Well, cat token has a whole ecosystem, whether that's sequencer fees or layer 1 fees or the AUSD yield or the chain owned liquidity yield. That all goes back into actually supporting the cat token to incentivize people to actually hold the cat token and invest in it and then earn yield on top of that. So there's a lot of yield on yield kind of stuff that makes sense for it. So just one of those things that I'm mentioning on there. You can absolutely sell it if you need to, but with Katana it's different on there. So yeah, as you were saying, like the fees take so long, what's the upside? Those the incentives are actually what is your upside to help you offset those losses faster. Now if the market is sideways, then you're just purely making profit, right? Like that's just a win. And if the market's going up, you are still making profit as well. Like as you saw you made more money on there, but with the fees and the tokens, if tokens are going up, your rewards are going up too. So like there's a lot of upsides to it too. But without like some kind of reward system, it kind of like sucks in a sense. So
Well,
Katana,
basically, yeah, if
yeah,
you enter into the, he was talking about impermanent loss before. I've been a little distracted, but I'm back. If you enter into the position and you exit at the same price you entered in, then there's no losses. The only time that impermanent loss becomes permanent is when you exit the position at a different price than you entered it. For these different pairs that he was just mentioning, people are eating losses right now because cat is not liquid. Once the cat token is liquid, the rewards is a form of yield that outweighs or should outweigh the losses that you're taking. People have different strategies and different bots that you can kind of auto sell cat to. Obviously, that's not what we want you to do, but like as an LP to protect profits and everything like that, you can basically sell the cat to help mitigate the losses.
absolutely. Yep. It depends on your strategy, right? What's your long-term reward? In a sense, I'm not saying believe in cat, but I'm saying we have done something different in DeFi, and you won't appreciate what we've done different until you totally understand exactly how all these things work, whether it's DEXes, bar lendings, perps, you know, how does it all work together? We're only on step 1 of this whole thing right here. So, and this is kind of what a perfect segue of like chain-wide fragmentation, right? Let's say you just see this workshop and you're like, hell yeah, I want to provide liquidity. I'm with it. I have a couple of $1,000s I want to sit. So you're sitting with your liquidity and you go to a chain and then all of a sudden you see tons of options, right? I'm on whatever chain and I see Dex one, I see Uniswap, and Dex I see Sushi Swap, and then Quick Swap and Sync Swap or any swap on there. So I have 4 Dexes right here. And so let me look at the pool rewards. Obviously, oh, they're here. LP rewards 50%. Good. Sushi Swap 100. Oh, nice. LP points. What the hell are points? I don't know. But obviously for me, I'm going to go right into the Sushi Swap and earn that 100% APY. But let's say next week those incentives change and all of a sudden Uniswap has the 100% APY. So am I going to break my position and go back and forth, right? There's just a lot of options. Everybody is fighting for that liquidity. So they're incentivizing you in different campaigns. So you've seen it all the time. Chain-wide campaigns, new layer 1 campaigns. They're always throwing different campaigns, but they never last on here, right? And then they give you different rates, right? Depending on how much volume or how much liquidity they have, you get different rates because they don't have enough liquidity. So you get a quote. Let me just raise that a little bit. You get a quote for like ETH for 29.90, 29.89 here at this DEX. This one has 29.91. This one has 29.90. The DEX fragmentation got so bad that you ended up having to create aggregators, right? And so by going through an aggregator, they would go through each one of those DEXes and then give you the best rate. And then all of a sudden there became API services that did this. And it became like, oh man, whoever's providing liquidity at whatever spot, or whoever has enough liquidity at one spot, it's great. And so the DEX aggregators are a great thing. They'd give you the best rate. But what happens if the DEX aggregator kind of forgets to check one DEX that has the best rate? And now you're not getting the best rate, right? So like you're in this like hope of blind trust of like, sometimes, you know, you're not getting to get the race rate, so you have to go manually do it. And do we want to manually do it for like a couple $1,000s every time? It's kind of a pain in the ass, to be honest, of like how many DEXs and how many. It is an open network and everybody can do it, but the problem is there's too many options, and with too many options, you don't know where to put your money, and then your money gets fragmented amongst everybody else's on the chain, you know, fragmentation on there. So Katana's value prop is we are very opinionated, right? You have your money, you have your liquidity. Where do you put it? We only support one DEX. So that's it. Like that's
there can be only one.
Yeah, only one. So it's kind of like going to a restaurant where they only sell burgers. Like I live in California area, so we have In-N-Out. The menu is, do you want a single or you want a double? You want it with cheese or not, right? If I take my girl somewhere, there's a big menu. It's too many options. It's like, I can't decide. I don't know what to do. There's spaghetti, and then there's steak, and then there's chicken and all that. From here, it's very opinionated. There's only one DEX, so you know exactly where to put your money and what pool to do. And we'll say that LP reward is here. Again, there is a chain-wide effort in order to keep these incentives high. It's not just SushiSwap trying to incentivize you. It's the Katana team. It's the sequencer fees. It's the vault bridge. It's the chain on liquidity. All those things are working together to keep these incentives high and not like a never-ending campaign, right? Sometimes there's a 3-month campaign. So you put your liquidity for 3 months, and like how Matt said, if the market's not good in 3 months and you exit, you took it at a loss, and basically you put your money in only to break out being even. So you took some risk to be even. Here we want to keep these incentives going on theoretically indefinitely. As the market moves and everything, there's always going to be reward to keep your money in, to keep that deep liquidity, and just keep that moving, is what we call the flywheel. So when we say things like flywheel, you're going to slowly start to get it as in. This is just one part of this moving system here. And so theoretically, once everybody uses one DEX, you will always have the best rate because you don't have to use an aggregator on there, right? So deep liquidity always gets you the best market rate. And that is kind of like the goal of what Katana is. Yes. So yeah, the loss will happen when you reposition your position, like your impermanent loss becomes permanent when you move stuff right here. So out of range, exactly, out of range. What do you do when you're out of the range, right? We started a max at 3,000 and then ETH hit 3,100. Do you just sit there and do you take the L? So what I do personally, I wait 2 or 3 days, right? ETH moves so much in dollar wise, and like ETH is very emotional. If someone says something negative, it just dumps. Vitalik, says something stupid, and then all of a sudden you got God, who's that Korean trader says something good, like he wants to buy ETH, he's going to say ETH is 20K, and all of a sudden it jumps to 3,100, right? Like it's a very, very emotional, very roller coaster type of proverb. It's not very static, right? So sometimes you could just wait it out. So if you're not earning fees for 2 days, just sit back. Sometimes the hardest thing is to do nothing. Sit back, and all of a sudden you come back in range, right? So like we said before, and how you guys are mentioning, impermanent loss becomes permanent when you actually close the position. When you close the position, now you've locked in that impermanent loss. Now it's permanent loss because there's no chance to come back. The market may not come back or anything. So that's why they call it impermanent. It's not permanent until you actually close that NFT position, get your tokens back. So what do? We rebalance, right? Like say you want to stay in the game. You're like, no, okay, I took a little bit of L here. I want to rebalance myself. So this is what we mean about rebalancing. Is we close our position, we sell some of our assets, and we open up a brand new position with a new range, right? It does have some impermanent loss. The impermanent loss depends on how much that you decide to rebalance with, right? So let's look at that example again. ETH is $3,000. We're all in USDC, right? All the apples are USDC. We close our position, right? So this LP position now becomes straight USDC. We've locked in the loss right here. As soon as we close that position, we exit, that loss is official. Right. So now we're sitting on this USDC. So I sell some of that USDC for whatever the value of ETH is right now. And so now I've got 50% USDC and 50% ETH on here. All I do is I create new position with a new range, and I have, 2,900, 3,100. Boom. I'm here with a new range. I'm back to earning fees. I took a little bit loss, but according to what I think the market is doing and everything, those fees and incentives will help me recover that loss and then make more money in this range, ideally, right? But what you do is you don't actually have to do a 50-50 split, right? You don't have to do that. Let's say ETH went up and I'm all in USDC. Again, we close the position, we lock in that loss again. So I'm sitting on USDC again. I sell some USDC for some ETH, but not much. I feel like ETH is going to come back down, but it's going to sit here for a little while, right? So I don't have to sell all my USDC. I'm just buying a small amount of ETH to keep that pool going. So you don't have to do a 50-50 LP position. You can do like a 95-5% or a 60-40. It's totally up to you on that. And I'll show you guys how to do that real time. But again, I'm feeling ETH will come back down, so I can dollar cost average in to balance on here. And so then I create that LP position here, and I feel like ETH will come back to like maybe 29.50, and then I'll be in the middle again, and I'll dollar cost average into ETH. So I don't take that much in permanent loss because I just, what I call is kind of like a snuggle or a nudge. Some people will say it. I just move that LP position a little bit over, and I think the market's going to stay in that range on there. I guess my initial numbers wrong. The market changed, so I just readjusted that on here. So hopefully you guys are following along. I don't see too many questions on there, but I'm just going to keep going. So we've talked a lot about like ETH USDC, but what about assets that grow in value together, right? So what we've been looking at right now is ETH, and we'll be creating this range of like ETH is between 2,900 to 3,000, right? And then when it goes out of range, we're out. ETH stays stable the whole time. It's always theoretically $1 in a sense, right? So anytime ETH goes, I'm in range, I'm out of range, depending on the market. We kind of get that flow. But what about tokens that grow together, right? Like if you look at, altcoins, sometimes they rise and fall with the value of ETH, right? So I'm going to use CAT as a theoretical example right here. We're going to say 1,000 CAT is 1 ETH. And so 1 CAT token is 0.001 ETH, 1,000th of an ETH, right? And at this value, 1 ETH is 1,000 USD dollars, right? So theoretically, 1,000 CAT is 1,000 USD. So let's say ETH takes off, jumps up, and now ETH is $3,000 for 1 ETH, right? Well, if CAT stayed 1-to-1 with it and it rose with ETH in value, well, then 1,000 CAT is 3,000 value. So it's still the same ratio. They're still the same elevation. So they didn't really go out of range. They kind of grew together here. So just so you guys can visually see that, I've created an LP position with 2 assets. And so instead of USDC value, I'm looking at terms of ETH. So I'm doing a range of 0.001 ETH because 1,000 CAT is 1 ETH, right? So it's 1,000 of ETH. And I'm going to say, okay, I'm going to put that range into 0.0009 and 0.0002, right? So what we have here is I have a 1-to-1 ratio. So let me go ahead and grab this so you can see it clearly. So this is the CAT token. And so let's say they're 1-to-1 exactly. And so I'm just going to have a little bit of separation so it looks like 3D. And then I have my range. So as ETH goes up in value and they change values, we're going to pretend that CAT has a 1-to-1. So as I have this range right here in the very beginning and it goes up in value, so does CAT. That range follows you. So instead of the actual ETH going in and out of positions, this range is now changing because it's still staying 0.001 all the way through. And then ultimately, if ETH outperforms a certain token, or if CAT outperforms, or if something's going down, something will lost, then the range will split apart. But if they stay 1-to-1, then you can indefinitely stay on there. So we have this relativity of like where the positions go. And then we call that a correlation matrix. I pulled this off CoinGecko, which is like, no, sorry, not CoinGecko, a DeFi Llama. Was like one of the places that you go to. Like it's one of the sacred relics of DeFi here to check rates and everything. But here's this correlation metrics, like what has BTC, ETH, USDT, like what correlations do they have together? And so you can see right here, BTC to ETH has had a 0.75 correlation, meaning that it doesn't go 1-to-1 and it separates a little bit. But we've noticed, like if you look at CoinGecko on here and like you see when Bitcoin goes up, ETH tends to go up too, right? Like those charts almost look the same in a sense. Maybe it goes a little bit higher, maybe it goes a little bit lower, but you'll see that it's at 1.2%. This one up 1.2%. So the correlation of both of them going up have been the past week about 0.75 close, right? BTC to USDT, a stable coin, not so much, right? It's been going way more. So you have a lot more volatility. And then because ETH is the same price of wrap staked ETH, 0.75, right? And so like when I do ETH to BTC, obviously the same one. to USDT to a stable. It has not been very stable, obviously, so it's not a very, you know, likewise item. But then we see wrap staked ETH to ETH is almost an exact copy of each other, right? So we have a lot of like stable like coins, so you have a lot of stability and you worry about impermanent loss. You can always create, you know, something that stays pretty close one to one. So the goal is, you know, you'll see a lot of these things of wrap staked ETH or wrap Bitcoin and ETH, WBTC ETH pools. Again, I only invest in stuff that I don't mind holding, right? So I have a BTC ETH position, and if BTC takes off and then ETH drops, I get a bunch of ETH. Boo-hoo, I have a lot of ETH to sit on, right? If ETH takes off and Bitcoin doesn't take off, boo-hoo, I'm sitting on Bitcoin, right? Like, so I don't mind on the market, but if they stay the same and correlating, I'm still earning fees on Bitcoin and ETH, right? I'm earning both of those fees plus incentives. Right. So you don't have to have it against a stable coin. Stable coins are nice. People like to stabilize. There's a lot of good volume. There's a lot of good incentives. But sometimes, you know, if you want to earn a little bit more than 2% on your wrap Bitcoin or, you know, whatever Bitcoin you have, you can just put it in a pool with something that you don't mind being like locked in with. Right. So a lot of BTC ETH pools do exist on there. And you can see the correlation. If you see something tightly correlated or there's another token that you want to tightly correlate with, you can look at DeFi Llama and see exactly how tightly they've been moving in history, right? Or you can look at the charts themselves. You can go over to CoinGecko.
Where'd you get this correlation matrix? I hadn't seen it before. It's good.
Oh, on DeFi Llama. Let me see if I can find this on the fly. We're gonna do it live. Let's see. DeFi Llama. Let's see. Custom. No, it's got to be under tools. And then correlations matrix by coin. So under tools, correlations metrics, and then I can start adding whatever token. Let's say I want to add Aave token or something right here. And then I can look at how well they've been correlating across the board. So Aave to BTC has been 0.82, so very closely. So when that moves, it moves, you know, with ETH, it moves a little separate. So depending on what kind of LP position you want to do, you can definitely look at that correlation. Let me zoom into that. So you can see exactly, you know, make your decision on like, what tokens do I want to pair together? When CAT comes out, do I want to provide liquidity? You don't know the correlation, but maybe a couple weeks later, instead of selling it, maybe you want to LP it and earn more fees, right? There's going to be highly incentivized fees to do that. You can start checking the correlations of like how well does it move with the other asset, right? Do you want to do CAT BTC, CAT ETH? Totally up to you, up to your decision on how you do that. You can even check it on CoinGecko. You can see like what the value is. Maybe like you're a solid ETH person, because we have like USOL on there as well. And you can look at CoinGecko and compare it with ETH, and you can see the ETH price correlation as well. So as certain prices go up, when is a good time to swap out? When is a good time to LP? You can make that decision on your own, right? Not financial advice. I'm just showing you the tools to make the magic happen, right? So boom. All right. Now, what do I do with this knowledge, right? You can do things manually, right? Like I've showed you how to do stuff on here, and I'm going to show you how to do it live with my own money. But you could do scripts with yourself or AI, right? Claude, ChatGPT, Gemini, all these things can help you do the mathematics. The examples for the impermanent loss I did with Claude. Claude Code has been very, very like popular the last 3-4 weeks. So you can start using tools. Again, protect your private keys. Don't do big amounts of money. Do a couple $100. There are tools that will help you for a fee, right? I don't want to rebalance. I don't want to claim fees or anything. VFAT is a very nice tool that I use for other networks. Right now, a little warning on there, because CAT is a liquid right now, not until at least February 20th, when CAT token is like in the smart contract, it will be live. That's the last day. It might be sooner, it might be later, but like February 20th is like the final day. But VFAT is something that I would cautiously use first, because the CAT rewards are liquid, so it won't auto compound for you. Or you don't want to deal with any of that. You're like, you know what, this is cool information, but I don't want any of that. You can use CharmFi. CharmFi will do this for you directly. So let me go into CharmFi. That is on Katana. And they will auto compound. And like, if you want to watch how they do it, they literally show you how they're doing it. I understand. I agree. You can look at Katana vaults on here as it loads. I'm gonna have to connect my wallet here using my RPC. And then let me see. Will it load? Yeah. Oh, my VAST doesn't like it. Hold on.
Oh no.
Yeah, that's all right. I'll disable it. I know it's safe. I've checked it here. Let me just kill the shield.
Surely it's fine.
Yeah, it's fine. And I don't know. I think my antivirus is blocking it again. We'll see. But anyways, on your own time, check out the Charm5 vaults and then see like how they rebalance stuff. They rebalance stuff every 24 hours. I think they do it through a script. Oh, there we go. And so let me see. Yeah, we'll say VB, USD, VBF. So when you look at stuff on Katana, you're not going to just see USDC and ETH. Yeah, VB stands for Vault Bridge. As your assets get deposited into Katana, they're already earning yield. So it's one of those things that you might have to get used to. The VB stands for Vault Bridge. It's basically yield earning assets. It's exactly USDC. It's exactly ETH in your terms. So just don't get confused with that. Don't get lost. But you can look at exactly how the liquidity distribution is. You'll see that they have the ranges between 2150 and 4,416. And you can see their vault strategy, how they rebalance every day, every 24 hours. You can see exactly how they are rebalancing. So learn from Charm5 if you want to do it yourself, or if you don't want to deal with it, just deposit it to Charm5, and then you can look at the performance ratio on there as you want.
So just to jump in here, everybody's preference is different in terms of risk reward. As Billy was talking about earlier, when you're rebalancing and you do take on that potential and permanent loss every time you do that and reposition. So what Charm5 has been really good at so far is farming and maximizing the amount of CAD tokens you're receiving. But on the flip side, you are incurring more impermanent loss than you might otherwise if you kind of just set it and forget it type, or directionally set it and forget it type. So it's kind of it's up to the like investor preferences. Also, I would say that you would probably, as an LP, change like your view on whether you're interested in Charm5, whether CAD token is listed or not. So obviously right now CAD is illiquid. That's something to consider. Once CAD is liquid, that kind of changes the whole product in a way. And so yeah, CAD will be liquid later this quarter. So I think we have like an exciting quarter overall for us.
Definitely keep an eye on Katana. And yeah, Jay Cosmos, yeah, I mean, like the BTC ETH yield is not that great, but it earns me more than just sitting in my wallet in a sense, right? Like if I earn 1% a year, that's still 1% more than I had if it was just sitting on the wallet on here. But yeah, monitoring tools. I personally like using DBank. I know we have a Xerion wallet and we have a few other ones on here, but DBank doesn't require me to sign up or anything. I just connect a wallet. So this is like a demo wallet I'm using on Ravi that I'm going to show you here. It lets me see my position. And more importantly, I created an LP position that I thought was going to be imbalanced, but it's not. But it's a great example to use right now that I popped in earlier this week. I did a VB USDC ETH pool, and I popped in a couple $100 right here, but you can see exactly how much USDC you have and how much ETH you had. Yesterday it was like 0.05 ETH and then more and like less USDC. And you can see exactly the rewards that I do have here as well. So like in the beginning, what is this, $222, my LP position, and I made $1 and some change on there. So I'm earning those rewards, but let's go into it directly and see exactly how to do this with SushiSwap, right? So let's go right into the Explorer. And let's look at this right here. Right now, we're seeing the total volume on Katana right now. This DEX right here is 85 million within the last day or so. You can look at it and see like how much volume has been happening across the network. Obviously, with December, like everywhere across every chain, volume's a little bit low, but it seems to be coming back. And then the specific dates, if you want to go into details, you can look at all the different details right here. So V3, remember we do concentrated liquidity, seems to be like where all the magic is happening here. So we're looking in the pools, and I'm going to pop in another ETH USDC pool right here. I want to deposit my money. I want to earn this yield. So let me go ahead and go in here and see what happens. So if you want to go into the details, you can see exactly how much volume has happened on every day. So you can make your decision like, oh, you know what, this is good volume. I want to participate in it. And you can see exactly how much TVL, how much balance there is and like where it is. So we have more ETH than USDC on here. And so let's go ahead and add some liquidity here. We're going to do real money. So I have my existing position.
Get a few million more in there.
Yeah, for sure.
$220? Come on.
This is a demo wallet, okay? They see my wallet.
Back on us.
They don't know what my ledger is, okay? They don't know those addresses. I'm keeping it quiet. This is the petty money right here. So yeah, so you'll see that my position is exactly a monitor of this one right here, this 222, and then I'm sitting on a couple $100 outside here, which is some ETH and USDC already ready to go. So yeah, let's go ahead and create my new position here. And so I like looking in terms of dollar signs. Like 0.003 ETH is just not my thing. I like looking at dollars. So let's go ahead and zoom in. Let's see. There we go. It's just taking a second here. So you can see where the distribution and where the liquidity is right off the top of like what's being provided liquidity. So like after $2,000, there's pretty much nobody providing liquidity, and above maybe $5,000, there's no liquidity. All the liquidity is being pushed right here in the middle. So there's a lot of liquidity, which makes it better swaps. And then in this small little range right here, there is more liquidity outside ranges. So like being in this zone, a lot of my money would be more efficient on here. That's how concentrated we want to be if we want to. But I'm going to play it safe. I want to put my range between, let's say, 2,900 to 3,200 and just kind of ride it out a little bit. That's what I feel like the market is doing right now. If you feel the market will change, hey, you can choose if you want to do full range. Full range is great, but look, your APY when you get that is 18%. So if you don't mind getting 18% through the whole market, you set and forget for 3 years and you earn 18%. Great. Not a bad payday. Deal. Yeah, it's not a bad payday, honestly. But let's say I want to be a little bit faster. I don't think ETH is going to go below 1,000. I don't think ETH is going to go above 10,000. So let's just bring that range in, and you'll see that as soon as I do a smaller range, that APY gets way, or APR gets way better. And if I keep it tighter, super tight, like this range of like couple $100, I'm getting 3,000%, right? Like if I really want to risk it and somehow it just stays in that range, I'll be earning 3,000% APR. But I'm not that crazy. I'm just going to go within the range of like, let me do a price of, and I can do this manually. I just want to show you the distribution. Minimum price of 2,900, and we'll do a max price of 3,200 right here. So within that range, a couple $100 on there, and there we go. So let's look at one important thing. As you'll see right here, the token ratio, right? ETH USDC. This is what I meant about the snuggle. You'll see that I only have 19% of ETH and 80% of USDC. It doesn't have to be the case. Maybe I want to snuggle that a little bit, so I can just move this over. And this center line is where that distribution happens. You'll see that it's a 50-50 now. Let's say I want to put more ETH than I do on USDC, and I feel like the USDC is going to kind of take off here, and I want more. I want a dollar cost average out. I can see that's more 89% ETH USDC, and I want to rebalance. So rebalancing is basically finding that middle spot of where I want to go. So you can easily move back and forth and pick your distribution of like what you want for your range on here. So again, it doesn't.
So whenever you move the range to the right there, you're basically speculating that you think the price of ETH is going up, and so you're starting at the low end of that pool so you can ride it out as long as possible, right?
Yep, exactly. So I'm like, I want to put just the minimal amount of this in this asset, so then I can just dollar cost average out, or however you want to go back and forth on here. So I'm just going to keep it right in the middle-ish, roughly 56.46, which is fine. I want to earn, I'm going to earn 731%. Check on me, guys. If the market changes, you know that I took the L. So let's go ahead and pop it in there. So you can use zap mode. If I only have one asset, I can zap in. I like to do it balanced, but if you only have ETH or if you only have USDC, you can just zap into it. But I'm just going to keep it nice and simple in here, and I'll do $100 of USDC, and it's going to automatically check in for me. Like, okay, if I have $100 USDC, it'll have about $130 of ETH on here. So I'm going to go ahead and improve my USDC. I'm going to wait for that to happen. That's my Brave notification. Cool. And then let's go ahead and preview it. Networks Katana, my fee tier is 0.05. And then, this is my range here. I want to send this ETH. And just, yes, I do. Let's go ahead and make the magic happen. And super cheap fees on Katana. It's like, I don't even know, is that like a cent or something? I don't know. What is that range?
Someday it'll be a cent.
There you go.
A long ways away.
Yeah. And boom. Done. And so like if I go into my positions, and it takes a little while for the indexer to show up here, but I will eventually see it. And there we go. There is my different range on here for that 298, 3, the 3,000 to 3.3. There we go. And so there's my position size. Those are my unclaimed fees. So if I check my wallet here, hopefully DBank updates pretty quickly. And there we go. I can watch both my positions on a browser, on my phone, see how it's going, see how I'm performing. You want to put this data into a dashboard that you just vibe coded to see like how much profit you're making. Absolutely, right? Those tools are there for you to make this life easier. But yeah, and then if I want to start claiming my fees, some of these fees are in Sushi, so we could claim my swap fees here. And then there's a lot of Merkle rewards too. So those are the rewards here. That's the CAT token and VB tokens. You can also claim that on the Merkle website as well. If you go to the V1, or sorry, not the V1, I just keep calling it V1, but if you go to app.katana network, yeah, and connect your wallet, you'll see that you have it on here. So if you want to bridge into Katana, I would say use app.katana network. You can bridge in here using the DEX swapper here. You can get from any network you want right here. There's I think ETH, Base, Arbitrum, all the heavy DeFi networks, and then you can bridge it right into the Katana network on here. Make sure to bridge an ETH. You do need ETH as gas to make this magic happen. I know we'll have account abstraction eventually at some point, but if you are a DeFi user, you're always going to want to have ETH on whatever chain you're going to do. So always import your ETH, or always bridge your ETH first before you do anything. And then you can see that you can claim your rewards here as well. On here, there's a claim button when you connect your wallet. It handles the fees from the DEX. It handles the fees from Merkle. It handles the fees from everywhere. So if I claim this, I can see exactly, what I've claimed across the board here. So
and
just an easy way to do it.
While we're on the Katana app, I think, this came out, the V1 came out over, I think, the holiday break in December. Yeah. Will built it to be very, very modular. So there'll be a lot of experimentation and gamification over the next quarter or two. So this is kind of like almost bare bones to what we're getting to. Obviously, you have the swapping ability, but eventually you'll be able to not even have to go to Sushi. You can come straight to Katana, provide liquidity there, manage your portfolio. We'll also have perps kind of coming out where you can kind of integrate and trade there. So I think this Katana app will be like a holistic experience for deploying your capital, managing your capital, and evaluating kind of your portfolio and what you want to do next.
Yeah, I think that's one of the confusing things about DeFi is you have to go to so many different places. And as a new DeFi user, if you say, oh, I want to LP into this position, you finally figured out what LPing meant. You're like, yeah, I understand this. I want to do it. And then the next step is go to this website you've never heard of. And you're like, what? Why? So that's one of the things we're going to be addressing in the Katana app this year, is to make it your DeFi home so that you have the same look, the same feel, and the same sense of security that you know who you're interacting with.
100%. I mean, like, if you guys know me from outside or from wherever, I'm a heavy DeFi guy. I wouldn't have joined Katana if I didn't think it was cool, to be honest. That's just the real talk on there of like, this is such a cool idea of like what's being tried here in the space, and then being able to interconnect. Right now, this is step one. This is DEXes. I would say this is complicated, but one of the easier concepts to understand. That's just one piece of like what makes Katana special. Just kind of a little bit of alpha. If you did sign up from the Luma, we do have the next one, right? Part 2, borrow lending on there. So that's going to be covering a lot of like, the concept of like what the bank is, what strategies I use, right? Like if maybe I don't want a dollar cost average into stuff, right? What I do is I have different strategies. Like when I'm doing an LP position and I have what I would do, I'm like, I don't want to risk it. Maybe I think ETH is going to take off and I want to have my exposure to ETH. What I do is I deposit ETH on borrow lending pool on Morpho. I want to keep that exposure to ETH, and I will borrow stables off that and then create LP positions with that borrow position, right? So then I can ride the fees on there that pays the borrow fees and then make extra money. And if ETH takes off, okay, my LP position gets, put into USDC, pay back my loan. I still have that exposure to ETH, right? So there's lots of strategies that you can do other than just doing LP position. There's a lot of things that you can do to maximize your money, leverage your money. And this is just like step one of it. Just everybody knows how to swap. I think this is a very foundational one, but as we get deeper and deeper into like what you can really do in the space and then ultimately become a delta neutral position, then you'll understand, and then you can truly appreciate what Katana is trying to do on here. So that was a little bit of alpha on here. Like it's coming up, DeFi part 2, borrow lending. I've already created the course on here. And so if you have any questions or feedback of like what you want to see, or maybe this was just not your thing, let me know, because I've kind of worked on them mostly. So if I need to make changes or anything, that is something that, you know, I can adjust, right? This workshop is made for you guys. This is something I wish somebody told me when I started. Like, I would just have LP positions and just get wrecked and like, hey, what happened? So I'm kind of telling you what it is. And so if you have any other questions, feel free to reach out, right? We are the Katana team. Those are our @.
No, you did a great job. Don't worry.
Yeah.
I think everybody did a great job.
So yeah, like these are our X usernames. So if you want to follow us, 0x Will Button, Matthew M Fisher 10x. He's a 10x kind of guy, and me, Billy.
That's alpha right there. 10x.
Yeah. So definitely, you know, see what can happen, right? If you want to talk strategies, the Discord is full of people talking about DeFi strategies. There are tons of places that you can go, but here's the only place I feel like you can get free content. I'm hoping to build your trust, right? Like, if you know me, I'm a no nonsense kind of guy. Like, if I think something's crap, I'll be like, that's garbage. You know, I don't trust it, right? So like, I'm coming from experience from like taking some L's all the way up to 2026. And so I'm like, if someone told me something, I wish they did, right? Like, don't keep this alpha. So there is no paid advertising. There's nothing here. If you have questions, feel free to ask us or tag us on there. And then hopefully Katana is your place to learn DeFi and some places to actually make some money, right? We'll check back at my positions in a couple of weeks on here and see if my LPs are still wrecked or not, or if I have to rebalance. We can always definitely follow up with that.
No, you have to show them the full MMA shirt.
Oh yeah.
Yeah, get that in.
Yeah.
I'm all Katana guys. So yeah, if you ever see me in an MMA fight or a jiu-jitsu fight or an open mat for a conference, maybe Eat Denver, you can check out the Katana. If there's another DevRel from other courses that want the smoke, come bring it. I'm ready. I was almost crazy thing. I was almost going to do the karate combat in Dubai. They just could not find someone in my weight class or that had enough experience to do it. Yeah, I'm like in a weird spot of pro and amateur where I just have too many years of experience. I'm also very, very heavy. So yeah, we'll see. Maybe one day.
Bring in a whole new aspect of DeFi. You got to fight your way in. You got to make it through Billy Jitsu to get in.
Yeah,
you want to be on Billy's side. So if you want to be on Billy's side, you might as well be on Katana's side.
100%. Yeah. Rebalancing again is one thing that you have to put some work in. A lot of people do scripts to make that happen. When you're talking about people that do rebalancing, a lot of it is automated, right? You're not sitting there in front of your machine, you automatic. So as the big plan and as I talk about dev rolling, a lot of this is like, there's a lot of devs that want to understand DeFi. There's a lot of devs that want to experiment with it. But if you don't understand how this stuff works to begin with, you can't really build anything. And hopefully while we were talking about stuff and explaining how the details work, there's a lot of missing pieces on here that could use a little bit more dev work. So hopefully it goes. Like, exactly, how do you measure impermanent loss? Is right now I use ChatGPT and Claude to like, hey, can you calculate my impermanent loss using these formulas from Uniswap v3 interface? And I do it. There's some calculators out there. There's people that sell Excel sheets, but I don't like paying for that stuff. So I'm using the power of AI to help me do that. But if you make a website that captures a permanent loss and you advertise on there, that's a way to make money in this space, right? If you make a tool that people use, people will use it. Like, yeah, so it's on. Yeah, again, you can't borrow 100%. You can only borrow maybe 80%. And I wouldn't even borrow 80%. We're going to talk about that when we do the borrow lending. But you can only borrow, I would say only borrow 50%. But that 50% borrowing can earn you 200% on there. So there's a lot of math on there as you discuss it. And like, again, that's experience that I've had. I'm reading the comments on here. Like, I'm just going to put it first for scope right here. Yeah, you can't borrow 100%, right? It's only a certain range of that. But depending on the money and how much risk you're willing to do, you can borrow, I would say 40 to 50% on there of the value of your ETH, because ETH goes up and down and you don't want to get liquidated. And then with that 50%, you can make a ton more money than if you just deposited that ETH for 2-3%, right? So really depends on your risk level, really depends on like how much you're willing to sleep. Like if I max lend, I can't sleep. I'll be honest. I'm like thinking about it all the time. Will I wake up liquidated or anything? And to the point where I started making tutorials of like how to do like bots that will save your liquidation. So literally one of the things that actually got me noticed with Katana team was I had created a Morpho bot that just paid back my loans. And so when ETH took a big dump, it started repaying some of my loans. I was like, hey, check it out. And I tweeted it out. And then they got, contacted by Maddie and she's like, hey, check out Katana. I was like, oh, let me check it out. And that's kind of like how I ended up with the Katana team. So yeah, lots of stuff to talk about. I can ramble on and on here, but we are at time. And if you missed it, it's going to be recorded. We're going to send out the Luma. If you haven't signed up to the Luma, check the Twitter for Katana to get to the Luma. It will remind you for the next one that is coming up. That'll probably be Friday the 23rd. I'll be gone next week, but keep an eye out for the NFT announcements. keep an eye out for all kinds of January now. There's so many things going on here. I'm going to be working while I'm away, so if just ping me anything. But thank you so much, guys, for the course. Thank you for not keeping me being boring, and I will catch you guys on the next stream.
There's also like I guess community kind of yield bearing NFT coming out soon. That should be pretty interesting for you guys. I think in 2 weeks maybe. So get ready to mint.
For sure.
We'll have a community content for sure.
The next couple months are just going to be pretty wild. So buckle up.
Definitely keep Katana on your like announcements or turning on those notifications, because there's a lot of stuff happening in the next 2 weeks. We're not going to get any sleep, guys. Look at us. Take a picture now and then take a picture in February. this week, we're going to look like the presidents after 4 years. But yeah, definitely a lot of work to do. Yeah. All right, guys. Peace out, guys.
All right, cool. Thanks, everyone. See y'all.